All right, before we jump in, just a quick and important reminder. Investing in the stock market comes with its own set of risks, so you should always read up on all the related documents before you invest. And remember, everything we talk about today is for educational and informational purposes only. It's not investment advice. So, you're looking at the FMCG space for your next big, long-term investment, right? You've probably got three names swirling around in your head: Hindustan Unilever, Nestle India, and ITC. They're all giants, but the big question is, which one is actually the best bet right now? Well, today we're putting them head-to-head in a stock showdown to figure out which of these titans looks like the real winner for the long haul. Let's get right into it. Here's how we're going to break it all down. First, we'll set the scene and talk about the current dilemma for investors in this sector. Then it's time for the main event, a three-round battle. We'll start with the growth race, then move to the valuation puzzle, and finish with a deep dive quality check. And of course, at the very end, we'll give you our final verdict on the top long-term pick. So, why are we doing this showdown right now? Well, India's fast-moving consumer goods sector is at a really interesting crossroads. The recent budget has kicked up a lot of dust, creating new opportunities and a whole lot of questions. This makes it the absolute perfect time to take a fresh look at these blue-chip stocks, because as you're about to see, each one is telling a very, very different story. Okay, let's meet our contenders. In the first corner, we have Hindustan Unilever, or HUL. It's the undisputed market leader. But right now, it's looking a lot like a value play, maybe even a turnaround story. In the second corner, we've got Nestle India, the very definition of a premium, high-quality stock. But boy, you're going to pay a premium price for it. And in the third corner, there's ITC, the diversified powerhouse. Think of it as the dividend king with a super low valuation and a very juicy yield. So we've got three totally different profiles here. All right, ding, ding, ding. Let's get to round one, the growth race. You know, in the FMCG world, growth is everything. It shows us who's really winning over customers and grabbing more market share. So the question is simple: whose sales are climbing the fastest? And we have a clear winner right out of the gate. Nestle India came out swinging, posting an absolutely incredible 18.5% year-over-year revenue growth in its latest quarter. Now, to put that into perspective, this wasn't just a good number, it was the company's strongest volume growth in almost 5 years. That signals some serious momentum. And just look at this chart. It tells the whole story. Nestle's 18.5% growth is just towering over the competition. The median for its peers, it was stuck way down in the 5 to 7% range during that same time. So yeah, Nestle isn't just winning this growth race, it's practically doing a victory lap around the others. Okay, after that absolutely dominant performance by Nestle, we head into round two, the valuation puzzle. Because, look, fantastic growth is one thing, but what are investors actually willing to pay for it? And this, my friends, is where the story gets a whole lot more interesting. To figure this out, we're going to use one of the most famous metrics in investing, the PE ratio, or price to earnings. Put simply, it just tells you how expensive a stock is compared to its profits. A really high PE means the market is expecting big things, lots of growth, while a low PE can mean you've found a bargain, or it could be a red flag. And this chart just perfectly lays out the puzzle we're trying to solve. On one end of the spectrum, you have ITC, trading at a really modest PE of around 17. In the middle, you've got HUL, sitting at about 53. And then all the way over on the other side is Nestle, our growth champion, trading at a sky-high PE of around 80. The message from the market is loud and clear. It's willing to pay a massive premium for Nestle's growth, while ITC is being priced like a deep value stock. So that's the million-dollar question, isn't it? Can that massive, massive premium for Nestle actually be justified? Well, that brings us to our final round, the quality check. This is where we pop the hood and look at the financial engine of each company to see who is truly running the most efficient and profitable machine. This table puts it all right there for us, side by side. First off, if you're an income investor, ITC is your clear winner with that amazing 4.4% dividend yield. But the real story is in that last column, return on capital employed, or ROCE. This basically measures how good a company is at turning its money into more money. HUL and ITC are both pretty strong here. But Nestle? I mean, look at that. It's in a completely different universe at a massive 95.6%. And if you thought that was impressive, it gets even better. When we look at return on equity, which is all about how much profit a company generates with the money shareholders have invested,
Nestle clocks in at an absolutely staggering 87.72%. Seriously, that level of efficiency is almost unheard of. And this metric, right here, is exactly why investors are willing to pay that 80 times PE premium. The company is just a masterclass in turning shareholder money into massive profits.
So the rounds are over, we've seen the scorecards, Nestle absolutely dominated on growth and quality, ITC was the clear winner on value, and HUL is sitting somewhere in the middle. Now it's time to weigh all the evidence and deliver our final verdict on the preferred long-term pick.
But first, it's really important to point out that even the experts are completely split on this. Just look at the brokerage ratings. They're all over the place. You've got Nomura saying buy on Nestle, but then Motilal Oswal and JM Financial are way more cautious because of that high price tag. At the same time, SBI Securities thinks HUL is the one to watch. The point is, there is no single easy answer here.
So let's just recap the tail of the tape one last time. HUL, it offers you value, but you're waiting for that growth engine to fire back up. Nestle, it gives you incredible quality and growth, but it comes at a very, very steep price. And ITC, it offers deep value and a fantastic dividend, but it's always got that shadow of its legacy tobacco business hanging over it, which keeps the valuation down. And this brings us to one of the most fundamental questions in investing. Do you hunt for a bargain, or do you believe that sometimes, just sometimes, undeniable quality is actually worth paying up for? After weighing everything, for a long-term compounding portfolio, our verdict lands on Nestle India. Look, the valuation is undeniably expensive. There's no getting around that. But its market leadership, its defensive moat in so many key product categories, and its track record of just brilliant, consistent execution are simply too powerful to ignore. That exceptional return on equity we saw, combined with its new focus on volume growth, just creates a powerful recipe for building wealth over the long term. It's a classic case of paying a premium for quality. And so that leaves us with one final question that I'll turn over to you. What kind of investor are you? Are you the value hunter, hoping for a turnaround with HUL? Are you the income seeker, drawn to that big dividend from ITC? Or do you believe fundamentally in paying up for the best-in-class quality of a company like Nestle? The answer really will define your own investment journey. Thanks so much for joining us for this FMCG Showdown. As always, please remember that investing in the stock market has its risks. This was purely for educational purposes, so make sure you do your own thorough research before making any investment decisions.